Joel Dean. I'm an investment advisor and certified financial planner at Capital Investment Advisors and a member of the Money Matters team. We got a question in here that I wanted to answer for you, and it's a common one. It's, should I pay down my student loans or contribute to my 401k? So this is one of the most common questions for young families just getting started in their financial journey. In fact, 62% of young adults who are pursuing a bachelor's degree take out a student loan in some form. And that number actually jumps up to about 75% when you start talking about graduate programs. Now, this makes sense because an education is an investment in yourself, but nobody likes the dark cloud of debt hanging over them. So it's easy to focus on paying that and dedicating cash flow to that area. But is that the best use, right? So I wrote an article actually that you can find in the link of this video that takes a deep dive into some of the videos. The first thing I found really in my research, and the first thing I tell folks when they're sitting across from me, is you need to see if you can refinance your loan to a lower rate. Stafford loans are the federal loans that get the lion's share of every dollar that is lent for students, but they don't have the most attractive rates. And in fact, oftentimes you can refinance through a company like SoFi and save a couple of percentage points. So for example, what that looks like is a $50,000 loan over 10 years. If you can knock 2 percentage points off that, is almost $6,000 in interest saved over that time period, or $50 less a month. So it's a good deal. So once you're able to take care of that or explore that option, if you do get a reduced rate, then it becomes, do I take this reduced payment and do I start dedicating my income and my cash flow to paying this off in a shorter time period, or should I just pay it over my 10 years and invest in the 401k where I could potentially get a higher return? And so really what this boils down to, it's called an interest rate arbitrage, where you are trying to lend money or borrow money at a lower rate than you can earn elsewhere in a place like a 401k. And so if you are paying 3.5%, let's say 4% on your student loan, and you can earn just by investing in your 401k about 9.5%, which is simply the long-term average of the S&P 500. You can take that route over 10 years and invest rather than pay off quickly. That's actually a difference in your 401k after the 10-year period of $29,000. So that in its own right is pretty compelling. But if you extrapolate that 25 more years down the road until your retirement, your $29,000, if it continues to earn what the S&P has earned historically, actually grows into a $310,000 lump sum. So that is a very meaningful difference when you take a long-term view over what this could mean for you. So I generally encourage my families that I sit across with to reduce that interest rate. And if they can get it to an area where they're comfortable saving for their 401k, that's generally a good route. So it all depends on you, your tolerance for risk. It depends on your tolerance for debt, what you can get your interest rate to. And it's something that we are more than happy to help you think through in person or via Zoom at Money Matters. If you have a question, feel free to reach out to me or anyone at the Money Matters team at yourwealth.com.